Welcome to the Deep Dive. We're here to sift through your source materials, articles, financials, analysis, and, well, pull out the key insights you need quickly. Today, we're tackling a really interesting one. A company right at the crossroads, you could say, of two huge high-energy revolutions, crypto and AI. We're focusing on Hut 8 Corp, ticker HUST, currently trading around, what, $36.24 USD?
That's right. And our core mission today is to dig into a pretty radical transformation they've undertaken. Hut 8 used to be, a pure Bitcoin miner now. They're explicitly saying, no, we're a vertically integrated digital infrastructure platform. So the big question for you is, have they actually built something resilient here for the long haul?
Or is it just, still basically tied to Bitcoin's price swings, just maybe with a different label?
Exactly. Is it a durable empire or just a volatile proxy?
And we can actually give you the bottom line from our analysis right up front. Based on the intrinsic value assessment, that current market price, $36.24. Well, it's sitting right at the very, very top end of our calculated educational range.
Which we figure is somewhere between $24 and $36 per share.
So what does that tell us? It suggests the market is pricing in almost perfect execution, like no hiccups allowed on a really complex, ambitious strategy.
Right. So let's unpack the assets and maybe more importantly, the risks that are feeding that level of market optimism.
Okay, that's staged nicely. We absolutely need to start with this big identity shift. Let's formally kick off the first part, looking at how the business is actually structured now.
Chapter 1, Business Understanding. Okay, the absolute key phrase here is the power first strategy. They made this official, like early 2025, and it's all about moving away from just mining.
Which is super volatile.
Exactly, and instead monetizing the core asset underneath it all, reliable and hopefully low-cost energy infrastructure.
Okay, so walk us through this new model. You said vertically integrated, 3 layers.
Yeah, 3 layers, designed basically to make money from energy and the facilities themselves. So layer 1, the foundation, is power. This is their energy assets. Think the 4 natural gas plants they co-own in Ontario, those long-term contracts they have with grid operators like ISO. It's the base.
And how's that performing, revenue-wise?
In Q2 2025, that layer brought in about $5.5 million. Steady foundational stuff.
Okay, then you build on top of that power, right? What's layer 2?
Exactly. Layer 2 is digital infrastructure. So these are the actual purpose-built facilities. High-density places. They rent space to other miners, that's ASIC collocation, and also offer more standard data center services to enterprises, which they call CPU collocation.
And the revenue from that piece?
A bit smaller in Q2 25, around $1.5 million.
Okay, so $5.5 million plus $1.5 million. That's $7 million from those two sort of stable infrastructure layers. But you mentioned a third layer.
Yes, and that's where the bulk of the revenue is currently coming from. Layer 3 is compute. This is the big one right now, generated $34.3 million in Q2 2025.
34 million. Wow. What's in that?
It's a mix. It includes their own Bitcoin mining, which is now run through that subsidiary, American Bitcoin. We'll probably talk more about that later. It also includes data center cloud services. And then the really interesting part, potentially, is the GPU as a service, or GPU AIS.
Ah, the AI angle.
Exactly. That's geared towards high-performance computing, AI workloads, run through their high-rise AI platform.
Okay, but hang on. If the stable parts, power and infrastructure, only brought in $7 million, but the, let's face it, more volatile compute part brought in over $34 million, doesn't that kind of suggest they're still, for all intents and purposes, mostly a mining company just, wearing a new hat for now?
That's a fair point based on the current revenue split. It absolutely shows their current reliance on that higher margin, but also higher risk compute layer. But the strategic value proposition, the story they're selling, isn't just about today's revenue. It's about the underlying asset, the energy capacity.
Sorry, the power.
Yeah. They manage 1,020 megawatts across 15 sites already. And the pipeline, it's just huge, 10,800 megawatts in development potential.
That is a massive pipeline. And I saw they recently pushed, 1,530 megawatts into active development. That sounds like they're really stepping on the gas.
They are. And that's the core strategic bet, isn't it? Mastering the art of securing massive amounts of power, ideally cheaply. That's the real moat here, potentially.
Because it serves both markets.
Precisely. They're sitting right where 2 huge trends meet. You got crypto mining, which, okay, it's maturing, but still growing at maybe 8-9% a year through 2032. And then you've got the absolute explosion in AI and high-performance computing. Data center power needs are projected to jump like 160% just between 2023 and 2030.
So HUD-8 is basically positioning itself as the power provider for both revolutions.
That's the plan. Their competitive edge is having or aiming to have the biggest shovel to dig for that power.
Okay, that's a huge strategic shift. It must require a pretty savvy management team to pull off something this complex. Let's pivot to them.
Right. Chapter 2, Management Evaluation.
What's interesting here is the team is actually quite new, right? The CEO, Asher Janud, only came in February 2024. Average senior tenure is just over a year.
Yeah, very fresh. But, despite that short tenure, they've already executed some highly complex financial maneuvers.
What's the American Bitcoin deal?
That's the prime example. Creating ABTC. They essentially carved out their pure mining operations, put them in this new subsidiary HUD-8 Corp, still owns 80% of it.
Okay.
And then they took ABTC public through a merger with another company, Griffon Digital Mining.
That sounds complicated. Why do that? Why not just keep the mining under the main HUD-8 umbrella?
It's a really sophisticated move, actually. It's about deconsolidating risk. See, the parent company, HE Corp, transforms itself. It becomes the exclusive infrastructure provider to its subsidiary, ABTC. It gets stable, long-term contracted revenue like a utility wants.
So the parent gets the stability.
Right. While the subsidiary, ABTC, which is the pure-play high-risk miner, can go out and raise its own capital for growth without dragging down the parent's balance sheet or maybe its valuation multiple. It's like building a firewall.
That's clever. It allows them to chase growth but try and make the main company look more, well, stable and predictable.
Exactly. Professionalize the image, maybe.
And speaking of growth and capital,
Yeah.
their focus seems crystal clear. It's all about expansion, right? I mean, no dividend, no major share buybacks,
No.
just massive capital commitments to that 1,530 megawatt expansion we talked about.
100% focus on growth. And that shows up when you look at metrics like return on invested capital, ROIC.
How does that look?
Well, it's a tale of two cities. Historically, the 5-year average ROIC reflects the old pure mining model, and it's deeply negative, like Medicus 63%.
Ouch.
Yeah. Now, the current trailing 12-month or TTM figure looks much better, around 13.1%. And this is but you have to be really careful with that number.
Why is that?
It's massively distorted. It includes huge non-cash gains from marking up the value of their Bitcoin holdings on their balance sheet.
Yeah.
It's not cash generated from operations.
The treasury effect.
Exactly. So the true operational effectiveness, the cash-generating power of this new infrastructure strategy, that really remains to be proven by actual cash returns from these big new projects they're building.
Okay, so we've got the strategy, the management moves. Let's dig into the numbers that define the stock right now.
Let's do it. Chapter 3, Financial Analysis.
Okay, first off, the market cap is substantial, around $3.82 billion. And the market is clearly expecting huge things. Analyst consensus is forecasting, what, 83.5% revenue growth next fiscal year?
Yeah, massive expectations baked in. But the first financial number that really jumps out when you look at their recent reports is the net profit margin.
How high is it?
Extraordinarily high on a TTM basis, somewhere between 111% and 113%.
Wait, over 100% profit margin? How is that even possible?
Right. It seems impossible until you see why. It's almost entirely driven by that massive $217.6 million non-cash gain on digital assets they recorded in Q2 2025.
So it's basically accounting gains from their Bitcoin holdings going up in value.
Yeah.
Not actual cash profit from selling services.
Precisely. It's an accounting gain, not operational cash flow. And this is critical because it makes standard metrics like the GAAP price-to-earnings ratio, which looks okay at about 25.7x.
Fundamentally flawed, right? You can't rely on it.
Exactly. It's just not a reliable indicator of value here because the E is distorted by non-cash items.
Okay, that's a massive distortion indeed. So if we ignore those paper profits, we need to look at the real engine, especially for a company pouring money into infrastructure. The cash flow. What does the free cash flow picture look like?
And this is where the story takes a sharp turn. Free cash flow, or FCF, is consistently and frankly deeply negative.
How deep?
The trailing 12-month FCF is a negative $325.3 million.
Wow. Negative $325 million. So just to be clear for the listener, what does that mean in simple terms?
It means the company is burning through cash at a very high rate. They're in a heavy investment phase, spending far more than they're bringing in from operations.
So they're not self-funding their ambitious growth plans.
Not even close. They're relying on external financing, selling some of that Bitcoin treasury they hold, maybe issuing more stock, to fuel that huge 1.5 gigawatt expansion.
Okay, so that negative FCF is crucial context for the valuation. You use a discounted cash flow model, right? Forecasting those future free cash flows.
Yes, that's the standard approach. projecting out future FCF and discounting it back to today's value. But given the risk profile here,
You had to use a high discount rate.
extremely high, we use 15%. And the reason is the stock's volatility. Its beta, which measures how much it moves compared to the market, is between 4.2 and 4.3.
Meaning it's like 4 times more volatile than the overall market.
Basically, yes. Hugely volatile. So you need that high discount rate to reflect the risk and create a realistic hurdle for those future cash flows to overcome.
Makes sense. So after running the numbers through that high-risk DCF model, what was the resulting educational value range?
The range we calculated comes out to $24 to $36 per share.
$24 to $36. And the stock is currently trading at $36.
Right at the absolute top of our estimated range, which, again, suggests the market price already reflects a very successful outcome.
Okay, so let's broaden out now and look at how the market is actually reacting to this complex story.
Chapter 4, Market Sentiment. And it really seems, as you said, complex is the word. It looks like there's extreme polarization out there. On one hand, analysts seem overwhelmingly positive.
Yeah, the consensus rating is a strong buy, about 1.24 on the standard scale. Very bullish on the surface.
But devil's in the devils.
The devil's in the details. Look at the actual price targets those analysts have set. They are incredibly wide.
So wide.
The range goes from a low of $18 all the way up to a high of $82.68.
$82. That's a massive spread, over 350% from low to high. Exactly. And what that huge range tells you is that analysts fundamentally disagree on how to value this thing. Specifically, how much value to assign today to that potential future AI infrastructure business versus its current reality, which is still heavily tied to crypto and involves burning a lot of cash.
So the bulls are betting big on the AI future. The bears, not so much.
And you see the bear case very clearly in the short interest figures.
Yeah, I saw that. It's really high, isn't it?
Very high. Between 17.1% and 18.7% of the available shares, the float, are sold short. That's a significant number of investors betting against the company, betting that management won't be able to execute this complex plan successfully.
So strong buy ratings, but huge target disagreements and heavy short interest. Talk about polarized.
It really is. Yet, despite those shorts, the stock itself has shown strong momentum recently.
Right, it's trading well above its moving averages.
Yeah, significantly above both its 50-day average, around $22.65, and its 200-day average, near $19.41. So there's been a powerful recent rally pushing the price up towards that top end of our valuation range.
Okay, so polarized analysts, significant short interest, but strong recent price action. Let's look at who is actually holding the shares. Who's making these bets?
Good question. Chapter 5, Ownership Structure.
The institutional ownership seems quite high. Big names like BlackRock, Vanguard, Coatue, they hold a majority, right?
Yeah.
Between
Yeah.
54% and 64%?
Correct. That's a significant institutional presence. And typically, having that much sophisticated money invested is seen as a vote of confidence in the long-term strategy, in this case, the pivot.
Any notable recent moves by those big players?
Yeah, some interesting ones. Vanguard recently upped its stake by almost 16%, and Columbia Management increased its holding by over 1,000%, which is quite aggressive.
Okay, so big institutions seem to be buying into the story, at least some of them. But what about the insiders, the management team themselves?
And this is where we find a really interesting, maybe slightly contradictory data point. Insider ownership is decent, around 10-11%. That usually aligns management with shareholders. But look at the actual transactions over the past year. We see 5 instances of insiders selling shares.
Okay, and how many insider buys on the open market?
0.
0 buys. That's telling, isn't it?
It's a subtle point, but potentially quite significant. The people who know the company best aren't stepping up to buy more shares with their own money at these current price levels. It kind of quietly supports the bear argument that maybe the stock is fully valued or even overvalued in the near term in management's own view.
Okay, institutions adding, insiders not buying.
Yeah.
Let's consolidate the major risks facing this whole strategy.
Absolutely. Chapter 6, Risk Assessment.
Maybe we can do a quick SWOT summary first. Strengths, weaknesses, opportunities, threats.
Sure. The core strength, undeniably, is that expertise in securing large-scale, low-cost energy. That's a foundation.
The biggest weakness, as we discussed, has to be that deep negative free cash flow, the cash burn.
Definitely. The massive opportunity, of course, is tapping into that explosive growth from AI and high-performance computing demand, leveraging their power base.
Okay, and threats, beyond the obvious execution risk.
There's a specific external threat we need to highlight, which is geopolitical and directly impacts their costs. The 2025 U.S. tariffs on imported mining hardware.
Ah, right. How significant is that?
It's pretty significant. It adds a 19% duty, which works out to about a 21.6% total extra cost on the specialized computer chips and machines that their subsidiary, American Bitcoin, needs to buy to operate and grow.
So that directly increases their capital expenditure budget, makes everything more expensive.
Exactly. It hits their bottom line, erodes the competitiveness of mining in the U.S. compared to other regions, and it's kind of a contradiction, right? The U.S. government says it wants to encourage domestic mining, but then slaps a big tariff on the essential equipment.
Yeah, that's a definite headwind. So boiling it down, what are the two absolute biggest risks here?
I'd say number one remains the unavoidable Bitcoin price volatility. Sentiment and often revenue for anything related to mining is still heavily influenced by Bitcoin's price, whether they like it or not. And number two is simply execution risk. Can they actually deliver on this massive 1.5 plus gigawatt expansion plan on time, on budget, especially given the current rate they're burning through cash? That's the multi-billion-dollar question.
Okay, that lays out the risks clearly. Let's bring it all together in a final conclusion.
Sounds good. Chapter 6, conclusion.
So summarizing the bull case for HUD 8, it's essentially pitched as this unique hybrid investment, right? You get leveraged exposure to Bitcoin's potential upside.
But theoretically, with some downside protection or mitigation coming from building this durable, diversified infrastructure platform focused on power, which should benefit from the AI boom regardless of what crypto does.
A sort of best of both worlds attempt.
That's the bull narrative. Conversely, the bear case sees it very differently.
How would you summarize the bear view?
The bears look at it and see a company burning through cash at an alarming rate, relying on accounting profits that aren't real cash, facing huge execution hurdles, and ultimately asking for a market valuation that seems overly optimistic given those risks.
Too much risk, too much hope baked into the price.
Pretty much. And just to reiterate that final value comparison for you, the listener.
The current market price, around $36.24 USD, is sitting right at the absolute ceiling of our calculated intrinsic value range, which is $24 to $36 per share.
So what that means is, at today's price, the market seems to have already priced in the best case scenario. Perfect, seamless execution of a very complex strategy across multiple fronts.
No room for error, basically.
Very little margin of safety, let's put it that way. So as an investor, you really have to decide if the potential future upside, however large it might be, justifies taking on that lack of cushion and the very significant risks we've discussed, especially that negative free cash flow and those looming tariff headwinds.
A fascinating, complex story indeed. Thanks for helping us unpack all the sources and dive deep into this transition. And maybe just one final thought to leave you with. Historically, the value of Bitcoin mining stocks has been, well, almost entirely chained to the price of Bitcoin itself. HUD 8 is actively trying to break that chain, demanding to be valued more like a stable infrastructure or utility company.
So the question you really need to ask yourself is, how many more quarters of watching them burn through hundreds of millions in cash are you willing to tolerate before you need to see proof? Proof that this power-first strategy can actually generate substantial, real operational cash flow on its own, separate from the wild swings of the crypto markets.
Something to definitely mull over. Okay, before you wrap up, a quick reminder. Please do like this video and subscribe to the Stock Analytics AI YouTube channel. If you become a member for just €4.99 a month, you get priority access to deep dives on specific tickers you request. We're planning to cover all of the S&P 500 stocks over the coming months, and members get that exclusive priority access. Or, if you just want a one-off deep dive on a company you're interested in, drop us a super thanks.
And the important disclaimer. This analysis was generated by an AI system using the source materials provided. It's for educational purposes only and absolutely should not be taken as financial advice. Please, always do your own thorough research or consult with a qualified financial advisor before making any investment decisions. We are simply reporting on and analyzing the information given to us.